Bill Ackman is the activist investor every CEO fears. Whether he's buying or shorting your stock, you know he's going to be loud, opinionated, and cause you a lot of trouble.
I don't think this stock gradually goes to zero. I think it's more of an overnight phenomenon.
He's willing to battle publicly and doesn't just want to be right, he wants the world to see that he's right.
Just want to point out a few things. We are short the stock of Herbalife. Herbalife stock goes down, we make money. Herbalife stock goes up, we lose money.
And every single glorious win and catastrophe in his career traces back to one thing: conviction. And conviction, real, unshakable, I'm going all in conviction.
So we have the benefit of starting small, but we have the similar benefits of being able to be a permanent owner.
Is the most dangerous thing a person can carry.
I think it's a huge win for us to get on the board. We were certainly the underdogs at the beginning of the contest. I think we're in a good place going into the election.
If you're right, it can make you rich with a net worth of $9 billion, and it can make you a legend. But if you're wrong, conviction is disastrous, and it'll make you exactly what you swore you'd never become. This is the story of Bill Ackman. Ackman's investing idol Warren Buffett once said that diversification is just a protection against ignorance. If you actually know what you're doing, you concentrate. You put everything on your best ideas. All the greatest investors live and die by their beliefs. They literally put their money where their mouth is by placing billion-dollar bets on their investments, but Ackman took Buffett's advice to heart more completely than maybe any investor alive. Today, you're gonna see what it looks like to actually build an entire career fueled on conviction. It's a story that involves nationally televised arguments, billion-dollar wins and losses, pyramid schemes, and even Brad Pitt. And by the end, you'll have to be the judge as to whether Ackman's life, philosophy, and investing strategy is something to be admired or viewed as a cautionary tale. Now, before getting started, if you're watching this video because you're interested in breaking into private equity, you may want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America PE at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code rareliquid to get up to $500 off, and I'll leave information for everything discussed in this video's description. And with that, let's go back into Ackman's story. Bill Ackman was born on May 11, 1966 in Chappaqua, New York, one of the most affluent suburbs in America, so this is not a rags to riches story. Ackman's father ran a successful real estate financing firm, so the world of business and money wasn't something Ackman had to discover. It was a world he was born into right from the start. This matters because it shaped how he would approach risk. When you grow up with a safety net, you tend to be more willing to take big swings because you've never seen what it looks like to actually fall with nothing underneath you. Here's a story that's a microcosm of Ackman's career. When he was in high school, he bet his dad $2,000 that he would score a perfect 800 on the verbal portion of the SAT. He ended up getting one question wrong, giving him a 780, which to this day he believes is not his fault. $2,000 was all the money Ackman had saved up at the time, and he was willing to risk it all based on his conviction in his abilities, and even when not achieving his goal, he refused to accept the outcome. This is a pattern you will see a lot as we go through his career. There's no other way to say it. Ackman was a cocky kid. He's 6'3", got into Harvard for rowing, and is a classically good-looking rich white kid. After graduating from college in 1988, Ackman worked at his father's real estate firm for 2 years and returned to Harvard for business school in 1990, where he co-captains the crew team again. He generates national controversy when he and his teammates paint dollar signs on their oars and t-shirts. But rather than apologize, Ackman writes an opinion column in the HBS student newspaper defending the decision, saying, "Let's face up to what Harvard Business School represents. We spend 90% of our studies here pursuing the maximization of the dollar." At 24 years old, he's brash, arrogant, and not afraid to fight in public. Something also clicks for Ackman during his time at business school. He starts investing and studies his idol Warren Buffett obsessively. He internalizes the idea that diversification is really just a sign that you don't have strong enough convictions, that if you truly understand a business, you concentrate and bet big. So that's exactly what he does, but here's the thing about betting big, you better be right. After graduating business school in 1992, Ackman doesn't just become a banker or consultant. He swings for the fences by launching Gotham Partners, a $3 million fund raised from friends and family. Ackman's strategy is value-oriented like Warren Buffett's, and the fund builds traction with a 20.7% return in its first year. In 1995, Leucadia National Corporation backs Gotham, and Ackman makes a spectacular bid for Rockefeller Center, which was facing bankruptcy. Ackman's bid doesn't win, but the attempt alone and David Rockefeller's public gratitude for Ackman's fair conduct puts his name in rooms it had never been in before, as investors balk at the confidence a 28-year-old has trying to outbid the big dogs. By the year 2000, Gotham would grow to $568 million in AUM, managing money for some of the most respected investors in America, with many years boasting 20 to 30% annual returns. But as early as 1997, Ackman was planting the seeds of his own destruction. In that year, he acquired a struggling golf course operator and renamed it Gotham Golf. His thesis was that Tiger Woods just won the Masters, the golf industry is booming. But rather than cutting his losses when the business underperforms, Ackman does what he always does. He doubles down. More courses, more debt, more conviction. The fund lends $15 million of its own capital just to keep Gotham Golf alive, making the classic mistake of throwing good money after the bad. And that's not the only problem. Gotham quietly drifts from undervalued public stocks into illiquid private bets, real estate trusts, .com incubators, a website called giftcertificates.com that can't even go public. The man who idolized Buffett is now chasing the same hype he looked down on. And here's the thing about illiquid investments. When investors want their money back, you can't just sell your assets and quickly turn them into cash. It takes time to find buyers for things like a golf course. And if you don't have enough cash to meet investor redemption demands, you have to sell your assets at a deep discount, destroying investor confidence and causing more redemption requests. It's a death spiral, and it's exactly what happens to Gotham. By 2000, $108 million in redemption requests arrive and another $72 million the following year. The New York Times would accurately describe that Ackman, who was once flying high, was now desperate, and so he crosses the line. As Gotham is collapsing, Ackman is accused of publishing bullish research praising one of their largest holdings, Prepaid Legal Services, while simultaneously quietly selling their own shares. The New York Attorney General Elliot Spitzer and the SEC opens investigations, and no charges are filed, but they add a final public humiliation to an already crumbling situation. On December 27, 2002, Ackman announces they are winding down Gotham Partners, and at 36 years old, Ackman's empire is gone, and while most people would give up, Ackman starts over and is already working on his next big bet. Ackman walks out of Gotham's ashes in 2004, and you can call it courage or delusion, but he still thinks he's a good investor and manages to raise $54 million to launch a new fund called Pershing Square. His first thesis is built around MBIA, a bond insurer with a pristine AAA credit rating, guaranteeing hundreds of billions in mortgage-backed securities. Ackman believed that MBIA's underlying credit was structurally faulty, and that if mortgage products blew up or if the housing market collapsed, MBIA wouldn't have the capital to cover the claims. Ackman believed the whole thing was just a house of cards. Wall Street laughs at him, and NBIA's CEO basically threatens Ackman to think very hard before releasing his report. And of course, Ackman releases it anyway.
Of securities, and in light of the supply-demand imbalance, you could have a big losses taken by money market mutual funds.
MBIA convinces Elliot Spitzer, the same guy who investigated Gotham, to open a market manipulation investigation into Ackman, and the SEC opens a parallel inquiry, but no charges are ever filed, and Ackman keeps building his short position while being publicly mocked for 6 years, until of course, the Great Recession in 2008.
Now, hedge fund manager Bill Ackman made the trade of a lifetime when he bet on a default by bond insurer MBIA. His wager set off a bitter feud with the company, one Ackman eventually won, making billions of dollars for his investors.
MBIA collapses exactly as Ackman said it would, and he closes Pershing Square's position in 2009 for a staggering $1.4 billion profit, and Ackman goes from idiot to genius practically overnight. Carrying this momentum, Ackman places an even bigger bet that makes him a legend. In 2009, General Growth Properties, the second largest mall operator in America, files for bankruptcy with $27 billion in debt. Everyone is running away from this thing as fast as they can, but Ackman buys it. His thesis is that the market is panicking and pricing the asset as if it's worthless, but the underlying real estate is worth dramatically more than the debt. Long story short, he's right. General Growth exits bankruptcy, restructures, and Ackman's investment returns 27 times its capital, turning $60 million into $1.6 billion.
We're going to do something different. We bought 25% of the company in the market for $60 million, starting at 34 cents a share. I joined the board, and then I helped the board run a process that benefited not just the creditors, but also the shareholders. The stock went from 34 cents to ultimately $31 a share.
By 2011, Pershing Square is one of the most high-profile activist funds on Wall Street. Every target Ackman selects puts markets in a frenzy, and its next target is Canadian Pacific Railway. Ackman accumulates a 14.2% stake and launches a proxy war to replace the CEO, a fight the entire board publicly opposes, but still, Ackman wins public support and takes over. He installs Hunter Harrison, a legendary railroad operator, as a new CEO, and the company's stock surges from $49 to $220 in 3 years, and Ackman exits with a $1.45 billion profit. Now, Ackman's track record wasn't perfect during this time. His most spectacular failure was in 2010 when he bought 18% of JCPenney and replaced its CEO with Ron Johnson, the man who built the Apple Store. 16 months later, sales fell by more than 25% and the stock by 50%, and Ackman agrees to rehire the old CEO, but 4 months later publicly attacks him through letters he directly releases to the media. It's public, it's ugly, and it's how Ackman does business. What happens is Ackman ultimately resigns from the board and exits his position with a loss of nearly $500 million. No investor can be right 100% of the time, but what made Ackman so compelling is that he turned activist investing into spectator sport. Whether he was losing 90% of his investment in Target or making billions in profits, Ackman wasn't sending quiet letters to boards. He was publishing 300-page research decks, booking CNBC appearances, and daring companies to argue with him in public. He weaponized transparency to build public support, move stocks, and sway investors, using a megaphone for every target, thesis, and bet. He didn't just want to be right, he wanted everyone to watch him be right. Pershing Square grew from a firm managing $54 million to over $12 billion, generating an incredible 692% return versus the S&P 500's 132% from 2004 to 2014. And right when he was riding high, Ackman makes the most famous and catastrophic bets of his career by challenging one of the most feared men on Wall Street, Carl Icahn. Now, the first thing I need to do is set some context and tell you about the historic beef between Ackman and Icahn. When Gotham was collapsing in 2003, Ackman needed to offload his fund's stake in a company called Hollywood Realty. He believed the stock was worth $140 but trading at $60, and he needed a buyer fast, so he cold calls Carl Icahn, who agrees to make the purchase. Icahn is 30 years older than Ackman and has been doing hostile takeovers since the 1970s and has a well-known reputation for being very, very difficult. Ackman knows exactly who he's dealing with, so he insists on a clause in the contract that's called schmuck insurance. If Icahn sells or transfers his shares within 3 years for a profit, he splits 50% of those gains with Ackman's investors, and Ackman even puts a mathematical formula in the contract like out of a textbook so there can be zero ambiguity. 13 months later, Hollywood merges with HRPT Property Trust for $136 a share. Icahn's profit is enormous, and Ackman calls to congratulate him and asks for his $4.5 million. Icahn says that it was a handshake deal, that Ackman came to him in a time of need, and that he wouldn't receive any of the profits. Ackman sues Icahn, and a long 7-year legal battle ensues, and in 2011, Icahn is ordered to pay $9 million due to the accrued interest, and after the check clears, Icahn calls Ackman to say he wants to be friends, to which Ackman tells him he has no interest in being friends.
And so, eventually we won. Eventually he paid. And then he called me. He said, "Bill, congratulations. Now we can be friends. And we can do some investing together." I'm like, "Carl, fuck you."
This is the underlying beef for one of the greatest Wall Street soap operas of all time. It's December 2012, Ackman is at the peak of his powers with $12 billion under management, and he's crowned Bloomberg's top hedge fund manager of the year. Ackman sends shockwaves across the industry as he announces the biggest short bet of his career, $1 billion against Herbalife, a nutritional supplements company that sells products through what he believes is a pyramid scheme. In typical fashion, Ackman is loud. He rents a conference room, invites 500 people, and delivers a 342-slide presentation calling Herbalife a predatory operation that specifically targets low-income and minority communities and promises to donate every dollar of profit he makes to charity. Within weeks, Carl Icahn takes the opposite side. He starts buying Herbalife stock publicly and aggressively, not necessarily because he believed in the company, but because he sees an opportunity to get revenge and squeeze Ackman on his short.
Most guys on Wall Street I sort of like and I get along with, and it's no secret I don't like Ackman. I don't respect him and I don't like him, and that's not a secret.
On January 25th, 2013, live on CNBC, Ackman is being interviewed about Herbalife when a producer patches in Icon without warning. What follows is 27 minutes of two billionaires calling each other liars on national television.
I really sort of had it with this guy Ackman, you know, and I'm telling you, he's like the crybaby in the schoolyard. I wouldn't have an investment with Ackman if you paid me to do it.
This is not an honest guy, and this is not a guy who keeps his word, and this is a guy who takes advantage of little people.
Trading on the New York Stock Exchange nearly stops, and traders on the floor are reportedly cheering on both sides. It's genuinely one of the greatest moments in the history of financial television. But here's the thing about the Herbalife short. Ackman is not wrong about the business model. Regulators look into it, and in 2016, Herbalife reaches a $200 million settlement with the FTC, which sounds like a win for Ackman, but Herbalife is not shut down and the stock doesn't go to zero. Every time regulators stop short of the kill shot, Herbalife survives, and Ackman's short position bleeds so much that by 2014, Ackman is down over $500 million on his position. Of course, he doubles down, giving more presentations, hiring lobbyists, and spending tens of millions of dollars trying to will this company into collapse, but nothing seems to work, and in 2018, he exits completely for a staggering $1 billion loss, but that would pale in comparison to his biggest public failure ever. Ackman has publicly stated that the darkest time in his life was during one of the worst investments in hedge fund history. In 2014, Ackman built a controversial $4 billion position in Valeant Pharmaceuticals, a company known for acquiring drugs and jacking up prices on life-saving medications. As usual, Ackman becomes a loud public advocate and tries to help Valeant acquire Allergan, the maker of Botox, in a hostile takeover. Allergan is instead acquired by activists, but Ackman owns a ton of Allergan shares and makes $2.6 billion on them, creating a massive controversy over whether he was guilty of insider trading. His Allergan trade was a win, but storms were brewing for Valeant. In 2015, a short seller named Citron Research published a report accusing Valeant of inflating revenues and deceiving investors, lose nearly 50% in a single day. Ackman defends the company publicly and aggressively, but he was wrong. Valeant's entire business model begins to unravel, and the stock drops a staggering 95%, and by March 2017, Ackman exits Valeant at an incredible loss of over $4 billion. Including Herbalife, Pershing Square loses roughly $5 billion across just two concentrated high-conviction bets, and Ackman feels the pain of his risk-it-all approach and is humiliated for being loudly and publicly wrong. During these implosions, he's also going through a divorce, but meets a woman named Neri Oxman, who he falls madly in love with, but one day mentions she's meeting Brad Pitt and doesn't text him the entire day, meaning not only is he losing his fund, he feels like he's losing his girl.
Funds down 35%, investors are redeeming, we got a court case that's going poorly, but then I meet this woman and she's just gorgeous and brilliant, and Brad Pitt's gonna steal my girlfriend.
Ackman's reputation is in freefall, but if you've learned anything by now, you know that this guy just doesn't give up and is addicted to betting big. And to his credit, in 2018, Ackman does something that actually breaks his normal patterns and is rare for someone with his ego. He publicly admits he was wrong. Not just on one trade, but his entire investment approach. He says he's going back to the basics. Fewer positions, businesses he understands, value-driven like Warren Buffett. He actually learns from his mistakes. He's still making concentrated bets, but now only in 8 to 12 positions max, and only on businesses he truly understands. Pershing Square enters its permanent capital era, preventing the investor redemptions that burned him in the past. And with that, Ackman mounts a comeback for the ages. The big position in Chipotle he started building in 2016 after the E. coli outbreak starts to pay off, leading to a 90% gain in 2019, a remarkable year in which Pershing Square incurs 0 realized losses the entire year and returns 58% to investors. Then in 2020, he makes the greatest trade of his career. As the COVID pandemic began to unravel, Ackman concluded that the market was dramatically underpricing the risk. Pershing Square puts $27 million into credit protection, essentially a bet that credit markets are about to implode, and goes on CNBC basically on the verge of tears, urging the government to shut the country down or risk catastrophic permanent damage.
I woke up with a nightmare. And my nightmare was you have this virus that replicates and infects incredibly rapidly. And if the president has to bring out the National Guard to keep people in their homes, which I don't think he will need to do, he should do it.
Only later does it become known that Ackman's $27 million hedge has ballooned to be worth $2.75 billion, and Ackman gets vilified for manipulating the markets again and profiting from a pandemic and a market downturn while also buying up the stocks he said would go to zero. And look, the optics are terrible, but here's why Ackman is not in jail. If you look into the actual timeline, Ackman has a defensible case. In his investor letter, he disclosed that he already started winding down his hedge starting on March 12th, which takes weeks to do, and he had already sold nearly half by his interview on March 18th. While he did say that hell was coming, he also mentioned in the interview that he was buying stock and was explaining why he was going from bearish to bullish. He completely exited the hedge on March 23rd and deployed the rest into beaten down stocks, ultimately resulting in a 70% return that year. The market ran with the market manipulation story, and it's certainly complicated given Ackman's history, but it's also clear that Ackman is back. He's still got it, but his next big battle would come in an entirely different arena. Since the COVID pandemic, Ackman has been in the news more often for his antics outside of investing. He received heavy backlash for making a mockery of pro tennis during his quote-unquote pro debut, where he basically bought himself a place in a tennis tournament, and he's also taken to X to usher in a new age of his personal propaganda. After the Hamas attack on Israel in October 2023, Ackman has been pointing his megaphone not to investments, but politics. He publicly called for Harvard to release the names of all student groups that signed a statement blaming Israel for Hamas's attack, so those students could be blacklisted by employers. He campaigned relentlessly for Harvard President Claudine Gay to be removed, pointing to accusations of both anti-Semitism and academic plagiarism, and eventually got her to resign. The financial media covers it like a victory lap for Ackman. He's the man who moves institutions. But then, Business Insider publishes an expose about his wife, a celebrated architect and MIT professor, claiming that her 2010 doctoral dissertation at MIT contains at least 15 passages lifted from Wikipedia and other sources without proper attribution. Now, let that land for a moment. The man who said Claudine Gay should lose her faculty position over plagiarism, who said students are forced to withdraw for much less, is now forced to defend his own wife for nearly the same identical conduct. Of course, that's what he does, and the hypocrisy is theatrical in its precision. Ackman threatens to launch a plagiarism review of all MIT faculty and leadership, and argues that MIT didn't formally require citation of Wikipedia sources until 2013, and extends his review to include Business Insider's own journalists. The internet, of course, is not kind about any of this. You can form your own view on the merits of each case, but the pattern here is impossible to miss. When Ackman believes in something, he goes in completely. He doesn't modulate based on how it looks. He doesn't recalibrate based on what's convenient. That's what makes him effective in his financial career. And it's what makes moments like this always so jarring to watch. Different context, different arena, same Bill Ackman. In 2026, Ackman is still swinging big. He's reportedly working to take a Pershing Square vehicle public again with an IPO, and proclaims to be uncancelable given all the controversies he's overcome. Because at this point, what can actually take him down? So, what can you really take away from all of this? The scoreboard isn't the story. The $5 billion loss on Herbalife and Valiant, the $2.6 billion profit from the COVID hedge, those are just numbers. The real story is what it costs to play the game of life as Ackman plays it. Ackman didn't lose $5 billion on 2 trades because he was stupid. He lost it because he was certain. And that certainty, the same certainty that held the MBIA short for 6 years while Wall Street laughed at him, is completely indistinguishable from the certainty that kept him defending Valiant on the Senate floor while the stock was down 95%. That's the part nobody talks about. Conviction doesn't come with an indicator that tells you when it's a superpower and when it's a blind spot. It feels exactly the same both times. That's what makes it so seductive and so dangerous. Of course, Ackman came from a wealthy family. He had a safety net that never put him at real risk, but he still swung bigger and more loudly than he ever needed to in his position, and constantly put his money and reputation on the line. You can say what you want about Ackman, his track record and ethical conduct is cloudy at best. But the people who change industries, force institutions to move, and build something that actually lasts, all of them have conviction. That's the sword they're willing to live by, and die by too. All right, so that's the story of Bill Ackman, someone I enjoyed looking into a lot. And if by chance you're watching this video because you want to eventually become an investor yourself, you're likely going to need to first break into banking. And I've created a fun little quiz you can use to see what your chances are to break into banking. Scan the QR code on the screen or use the link in the description to check it out. And with that said, thanks for watching as always, and feel free to check out my last video on Catalyst, the most feared bank in Silicon Valley, if you want more videos like this.